Well, the Fed has signaled its fight against inflation is ongoing despite its decision to hold rates steady in June. When asked about the choice to hold during the press conference yesterday, Fed Chair Powell defended the FOMC's reasonable choice to slow the pace. Take a listen.
Why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower.
Let's bring in Nick Timiraos, Wall Street Journal's chief economics correspondent. He joins us now. Nick, that was your question there, and I'm curious to get your read on the Fed chair's response to that and what that says about how he's keeping his options open, especially with the economic data that's likely to come between now and July.
Yeah, it's a good question, Akiko. Thanks for having me. I guess there are two ways to think about what the Fed is doing here. One way that they've communicated this is we just want more time to look at the data. So they had 6 weeks of data between the May and the June meeting. They'll get another 6 weeks of data between the June and the July meeting. And that case it's a little bit confusing, I think, to people because they're looking at the warm-ish data that we had between May and June and saying, well, if you didn't increase interest rates on the basis of that data, do you need to see even hotter data over the next month to go in July? And I don't think that's the case here. So the second explanation for what they're doing, which is what Powell essentially teased, I think, in his answer there, is that they're moving to a quarterly baseline pace of rate increases. And so you want to look at 3 months of data instead of 6 weeks of data. And if that's the case, then they already have more than half of the data that they're going to get before the July meeting to make their decision. And that creates, I think, that's why you see the expectations of another increase in July is just because they didn't raise in June on the basis of that slightly firmer inflation and activity that we saw in May and early June doesn't mean that it has to get dramatically worse for them to go in July.
So, Nick, to your point, I mean, this kind of also goes to the question that Bloomberg's Michael McKee asked, which is it time or is it data? In other words, if you get to the next meeting and nothing has changed, do you go ahead and do the rate increase? And in your mind, is that indeed the base case here, given what we heard yesterday?
I think it is. I think it is. And it could get confusing and messy because people always say we're going to know a lot more in 6 weeks, but often you don't, right? Things have been confusing all year long. There hasn't been a clear upward or downward move in inflation, right? Things have just sort of, they've gotten a lot better on headline, but not a lot better on core. Again, as the clip of Powell that you played showed. So it's hard, but not impossible to come up with a list of reasons why the Fed might not hike in July. You could see a weak payroll report, but we haven't had any weak payroll reports in the last year. You could see more banking or financial market turmoil. You are going to get second quarter earnings later in July. Investors will want to look at what net interest margins have been for those banks that lost deposits. Have they had to really pay up for deposits? And so is the profitability of these banks really going to be a serious concern? You could get some other unanticipated shock. You're going to get one more inflation report, and people say, well, what about a weak inflation number? Would that be enough? I don't think it would. Listen to what Fed Governor Chris Waller has been saying for the last year. They don't want to be head faked by one positive inflation report because that's already happened a couple times now where they got some better inflation data in the fall and then it got revised away. They had better inflation data in September, August of 2021. Which led them to hold on to the transitory explanation in hindsight longer than they should have. So 1 week inflation report here, the June CPI, may not be enough to hold them back from hiking in July. And so it really raises the question, How much weakness would you need to see in the other data? And will you actually see that weakness? I don't know.
Nick, you mentioned the stress in the banking sector that we've been seeing. We had a guest on yesterday who seemed to suggest that the primary driver for the pause or skip that happened yesterday was because of what has played out within the regional banks. The Fed chair was asked about that yesterday. He didn't really answer the question. What's your sense on how big of a factor that's likely to play on the pace of these hikes?
Yeah, I think all things equal, the banking stress did play a role in this idea of spacing out these next few moves. You get more time to see what's happening in the economy and in the banking sector. What's interesting is that, before the run on Silicon Valley Bank, Powell had basically signaled that they were shifting their base case terminal rate up to 5.6%. Then they ended up not doing that after the events of mid-March. They held their terminal rate steady at 5.1% in the March projections. And yesterday, what Powell essentially said was, we think we're going back to that pre-SVB terminal rate, but they're getting there over a longer period of time. And you can see the market is not at all convinced about that second hike that was penciled in yesterday. There seems to be, a high mass, a lot of probability that the Fed will go again in July in the market pricing right now, but not so much after that. And by spacing out those next few moves, you do give the economy and the data more time to decay and to sort of show the hawks on the committee, we really don't have to do this.
Nick, as always, there was a lot of commentary following the press conference about the effectiveness of the Fed chair's communication, right? Sort of saying it's a skip, I shouldn't call it a skip, sort of right. Maybe contradicting himself at times. Do you think that Jay Powell is sort of transparent to a fault, that he's communicating this way because he's sort of thinking out loud? I mean, you cover him very closely, so I'm just curious what your impression of that is.
I try not to get into opinions, but I think that's that's definitely a reasonable view. It's one that I've heard from others. I think that, as I think about Powell, I wrote a book last year that focused a lot on Powell. He's had two messages over the last year. The first message is the Jackson Hole message from August of 2022, which is, we have to stick with this, just like Volcker did. We cannot fail, right? That is sort of overarching message number one. But the second message, which is not contradictory at all, but does provide more nuance. We heard it at Brookings last November, and we heard it a little bit again yesterday, which is we don't want to crash this thing if we don't have to. He said at Brookings something like, I don't want to just raise rates, crash the economy, and then come clean everything up afterwards. And so long as they see some slim chance of a little bit of immaculate disinflation, a softish landing, then they're going to try to go for it. And I think that's sometimes why you get some of this dissonance, is people say, well, he's no longer doing the Volcker routine that he did at Jackson Hole. And you did hear some of that yesterday. They absolutely believe they can't fail on getting inflation down. But when you've seen headline inflation come from 9 to 4%, you've seen 1 year inflation expectations come down, not quite as dramatically, but similar path, then you've removed that right tail risk of unanchored inflation expectations to some extent. And it does allow them to be a little bit more patient. On the other hand, Powell's also got to be looking at what's happening in Canada and Australia, countries that slowed down interest rate increases, central banks that paused earlier this year and are going again. And then you look at the UK and what's happening with wages and prices. They're absolutely not a place the Fed wants to be. So those are maybe cautionary signs of not unfurling the mission accomplished banner too soon.
So taking that point about not wanting to crash things if you don't have to, I mean, do you get the sense that given where the policy is right now and where the data is, that the Fed's kind of getting closer to that potential for a soft landing, that's an increasing likelihood?
I don't know. I mean, I talk to a lot of people in the markets who think that it's going to be harder to pull this off because of how much debt how much companies borrowed and financials borrowed at low rates, thought rates were going to be low forever, and this higher for longer, even if the Fed doesn't keep raising, if they just hold above 5% for longer than a lot of institutions have expected, as debts come due, as loans roll over, you are going to see more stress. It's just we haven't gotten to those cliffs yet, and so you're not going to see it until you get there. But once you get there, you'll see it. So I think that's why the prospect of a soft landing maybe is fairly low. But there's a difference between having a mild recession and a really bad recession. And so you could read Powell at Jackson Hole as saying, it may be that we're going to have to go through a recession, but hopefully it won't be too bad. And the follow-up to that being, we really don't want to make the recession worse than it has to be if we're going to go into a recession to, make sure that inflation doesn't stay out of control.
As one of our guests earlier put it, Nick, wouldn't want that job. It's not an easy one. Nick Timiraos, thank you so much. Wall Street Journal Chief Economics Correspondent. Appreciate your time this morning.